Welcome to the Lend Academy podcast, session number 17. This is your host, Peter Renton, founder of Lend Academy. We have a great guest for you today on the show. Noah Breslow is the CEO of OnDeck. And OnDeck are really one of the leaders in the small business lending space. They've done over $1 billion in loans. They've been around since 2007. And so we talk with Noah about his company, about what their place is in the small business lending ecosystem, talk a lot about the kinds of borrowers who come to OnDeck, what they're using the money for. And we get into some of the nitty gritty around how they're able to underwrite the loans and the OnDeck score, which is their proprietary kind of the equivalent of the consumer space of a FICO score, something they've developed and relied upon very successfully. So hope you enjoy the show. Okay, welcome to the podcast, Noah.
Thanks so much, Peter. We appreciate the chance to be here.
Okay, well, let's get started with just giving a bit of background about yourself, about your career path and how you came to work at OnDeck.
Sure, no, happy to. It wasn't a traditional career path to do what I'm doing today. I studied computer science in college. I went to MIT, and I was an engineer basically after college. I was designing communication systems for satellites. I did that for a number of years in Seattle and London. I went back to business school, and then for the last 10 years, 12 years or so, I've been living in New York, working in venture-backed software companies. My last one was sold in 2006. And I was looking for the next thing to do, and I got introduced to a guy named Mitch Jacobs, who's the founder of OnDeck, and really just kind of fell in love with the opportunity. I mean, it felt like it was an area that small businesses weren't being served well by traditional institutions, and technology could really make a big difference in how loans were delivered to these businesses. So I signed on in 2007 and haven't looked back since.
Right. I read somewhere that you were the first employee. Is that correct?
That's correct. Yeah. So after Mitch, the founder, had the initial idea, I was the guy who kind of got recruited in to help build it and make it a reality.
Okay, cool. So why don't you give the listeners who might not be familiar with OnDeck, just give a little bit of background about your model and what you do.
Sure, no, happy to. So OnDeck, has been around since 2006 when it was founded. We made our first loan in August of 2007, and we provide loans to small businesses, typically Main Street businesses, restaurants, auto repair stores, nail salons, grocers, doctors, and dentists. Loans of anywhere from $5,000 to $250,000, and we provide those loans over shorter terms than traditional banks, so anywhere from 3 to 24 months. And traditionally, this group has had a hard time accessing capital from traditional banks. So we really thought it was a part of the market that needed a new solution. And what we're doing with our technology essentially is moving that whole entire lending process from offline to online. So a process that used to take these business owners either weeks or months can now take either minutes or days.
So do you think before OnDeck, most of these people would have just not bothered with a loan or just done it on their personal credit card or something?
Yeah, we saw a lot of substitutes. It's funny, people always ask if OnDeck was some kind of counter-cyclical business that got started in the wake of the credit crisis. And the funny thing is actually the business plan and the launch happened in the last credit boom. So we always felt this segment was underserved. And there's a variety of reasons why. One is traditionally personal credit, while it's very useful to get businesses off the ground, may not always be the best thing to help businesses scale. And then the other thing is, the search costs are massive. The New York Fed did a study. It takes the average business owner 26 hours of work on their end to go look for a loan, and they have to apply to 3 different institutions. So it was a very inefficient process, a very slow process, and that discouraged, frankly, a lot of business owners from getting financing.
Right. So let's talk about those business owners. I've heard you mentioned about the wide variety of businesses that come to OnDeck. Can you paint a picture of 2 or 3 of the typical types of clients that you have?
Sure. So we've provided capital now to businesses, all 50 states, over 700 different industries. And I think your point about diversity is absolutely the critical one here. And we see diversity In the size of business, you have businesses that are just maybe a single employee or several employees. You have businesses that are dozens or more of employees. You have businesses in different industries. So a restaurant, for example, is a very different type of customer potentially for a loan than a dentist might be. They have very different profiles. And then we see also a really wide range of tenure. In a given day at OnDeck, you might have a business owner apply for a loan who's been around 18 months and who's never borrowed in the name of the business before. You may have another business owner who's been around 20 years and who has plenty of trade credit or bank line of credit, and that all those businesses have different data footprints. Our typical customer, if you sort of average everything out, which can be a little bit, not representative of every different unique type, but if you average it out, it's about 10 years in business on average. These are very established small businesses. They do about $1 million in annual revenue, anywhere from 5 to 25 employees, and basically have usually around $15,000 in the bank.
Okay, so these are established businesses that you're not looking at anywhere near startups then. You're really looking at...
Generally, that's right. I mean, we absolutely will start as low as a year time in business, but the whole idea behind the OnDeck score and really the company is we want to analyze your business as a business. And so we need a track record of performance to analyze. And so startups, unfortunately, we get folks who come to our website and we ask them for the name of their business and they write "to be determined." That's going to be a tougher fit for us, than someone who's been around for a few years and actually has some customers and revenue.
Right. And so what are the reasons then they come to you? And you talk about the 26 hours. Obviously, that's a huge stumbling block for a lot of business owners. I mean, is it the ease? What's the main reason that people will come to OnDeck as opposed to alternatives, like traditional sources?
Yeah, I think there's really sort of two categories of borrowers. We see folks who come to us for access to capital, as well as folks who come to us for ease and speed and convenience. So maybe just taking the first scenario, from the access point of view, our number one vertical that we lend into is restaurants, and restaurants are a vertical that banks really don't enjoy lending to. They perceive the category as being either higher risk or potentially more volatile. The businesses are generally on the smaller end of things. And frankly, there's a lot of bias we've seen at the bank level, where someone uses personal credit, let's say, to get their business off the ground. They establish that restaurant on personal credit. 2 to 3 years in, the FICO score has no awareness of you having a $1 or $2 million restaurant attached to you as a consumer. And so you get a suboptimal decision. So our algorithms, because we look at business performance, can approve businesses that banks have historically underserved. On the speed front, you bet, it's a huge part of this. We recently did an economic impact survey, and I know we'll talk a little bit more about that later. But one of the most striking findings was that a lot of our customers simply perceive the lending process from banks or the SBA as taking way, way too long. And so they sit on the sidelines. They don't take advantage of certain growth opportunities in their business. A great example might be, again, coming back to our restaurant example, someone who gets a job for a catering event on a Wednesday, and they have to fulfill that catering event over the weekend. They might need to buy food and supplies or hire workers, to make that event happen. But if they can't get capital quickly, they may not be able to say yes to that job. So having capital on demand, we found, is a powerful thing for business owners as they think about operating their business. And it's really that speed and ease of our product that enables that to happen.
Right. Okay. So then you're getting, I imagine now you've been in business since 2007. You're getting a bunch of people who are coming back for a second, third, fourth loan. Is that pretty typical?
Yeah, that is typical, although not of every borrower. So half of our customers will take one loan and then never come back, or at least they haven't come back yet, and we think that makes total sense. I mean, so they're taking a loan for a very specific need, and then they come back, if they need capital again. We do have some borrowers that have more frequent needs than that. Typically, we see every 12 to 18 months or so, and particularly around seasonal patterns. Yeah. You might have a retailer that's stocking up for Christmas, and Christmas comes around every year, so it's very natural for them to take a loan, buy additional inventory, which is the most common use of our loans, actually, sell that inventory through in a matter of months and then come back around next year for a second or third loan. Right.
Okay. That makes sense. So let's talk about how you're funding these loans. I mean, you've been, traditionally, you've been established. You had a line of credit. You were a balance sheet lender, and I've heard you talk about the OnDeck marketplace now. You're providing whole loans to investors. I mean, what? Are you planning on doing both? I mean, are you moving more to be a marketplace type lender? Where are you at these days?
We are believers that what we call the hybrid model is the optimal solution for our business. So, I think going back to the historical reasons why OnDeck's development, for example, is very different than, say, a Lending Club or a Prosper, those businesses were largely doing consumer lending and largely doing it based on FICO with additional, work they had done on enhancing that credit model. In our case, we were really trying to lend to a new population using a different set of data than had been used before. And so we've created this thing we call the OnDeck score. And because the OnDeck score was proprietary, it was new, we had to sort of put our money where our mouth was for 5 or 6 years to build out a track record around that score. So as a result, we went after a sort of a balance sheet model where OnDeck bore the first loss position and then investors provided capital, but essentially that capital was senior debt, to the business or to the loans themselves, and not sort of investors taking the full risk of the loan. In as the business has now evolved, both the recent securitization we've done as well as OnDeck Marketplace are both examples of a case where investors now understand the predictive power of the OnDeck score for this sort of Main Street customer, and they're comfortable taking on more of that risk. So we are adding new funding sources to the business. In particular, the OnDeck Marketplace, investors are buying whole loans on our platform, and we expect that to continue. We're in kind of a pilot phase now, developing that program out, but we think it will grow over time.
Okay, so you want to maintain both levels, both sort of kinds of capital. It sounds like, as far as funding your loans, do you think about going into like fractional loans and even going out just to regular accredited investors, or is that on your roadmap or not?
To be candid, right now, we've largely been focused on institutional investors, and because they're institutional investors, they're largely deploying, good-sized chunks of capital, right? They're making $5, $10, $20 million investments in our loans. And so because of that, we haven't had to go all the way to fractional loans. And because of the depth of demand right now in the investor base, we haven't had to go all the way down to the retail investor either. So right now we have no active plans to do either of those two initiatives. We're open-minded about it. If it makes sense at some point in the future, that's fine. But right now the depth of demand, and you probably saw it at Lendit, is just massive from investors for these types of assets and these types of origination platforms.
Right. So if an institutional investor comes along to you today, are you taking on new investors? How are you handling that?
We will absolutely engage with them and talk to them about the platform. At the same time, we definitely have a wait list at this point, and a lot of our volume over the next sort of 6 to 12 months is fairly spoken for via forward commitments we've got from the existing investors on the marketplace. Right.
Okay. And so as far as the marketplace goes, then with the whole loans, are you going to maintain like increase the percentage of your loans? Because obviously this is a fairly new initiative for you. And, as you said, there's a ton of institutional interest in this space. I mean, are you going to increase the percentage rather than relying so much on your balance sheet, going to more of the outside capital? Is that going to increase over time?
Yeah, I think it is natural to expect it to increase over time. We're sort of holding off from giving forward guidance on exactly how much it will increase, but it's safe to say we're in a pilot mode, and right now it's going very well, and we're just it is going to expand over the next year or two.
Right. Okay. So let's just talk a little about the loans themselves. What you've got a range of duration. I know a range of amounts and interest rates. Can you give the listeners a bit of an idea about the kinds of different loans that you have?
Sure. So, we offer term loans today anywhere from 3 to 24 months. And the typical amounts can range from anywhere from $5,000 to $250,000. Our average loan, just to give you an idea, Peter, is about $40,000.
Okay. And the average, what's that, like a 9-month average duration, 8 months?
Yeah. So our most common loan is a 6-month loan, actually, but the weighted average of the portfolio is about 11 months right now. But that number will move around a little bit, just depending on the mix that we see in any given period. Right.
Okay. Fair enough. And then, as far as the interest rates go, I know that the OnDeck 24 product, I saw you say that it's ranging from like 19% up to 39% APRs. What about the rest of your loan book?
Right. So the weighted average annualized interest rates for our portfolio is about 54%. So, what that means essentially, given that most of our loans are 6-month loans and they're amortizing, as our borrowers pay a much lower dollar cost of the loan than that.
Right.
But on a weighted average basis, if you annualize all the rates and kind of correct for time, it's about 54%.
Okay. So then let's just talk about I want to talk about the Bloomberg article that that came out a few weeks ago. That was, it was a very negative article comparing you to payday lending. I thought it was somewhat unfair for you guys actually to be included in that. But you're talking about, the Jordan Belforts, and people who have been in prison coming, as a way, and then now they're in the online, they're in the small business lending space. So I guess the question is, with your securitization, which we'll talk about in a little bit, a lot of this stuff became public record for the first time. And this Bloomberg reporter obviously picked up on that. So when you talk about 54% APR, even though it might be a 6-month fully amortizing loan, so they're not going to pay anything near like that kind of rate for over the course, during the if you annualize, during the loan term anyway. My point is that these loans, you obviously are passionate. I hear you talk and you're passionate about your business. How are these loans a good financial decision for all of your borrowers?
Yeah, happy to address that, Peter. I think it's a very important question. Why did OnDeck choose this particular price point, right? We could have operated the business at a number of different price points, at least in theory. And so if you look back to the context in which we started the business, you had banks on one side of the equation serving a very, very small fraction of small business owners. And on the other side, at the time in 2007, when we made our first loans, there was a product called the Merchant Cash Advance. And it was a lightly regulated, area of the market. A lot of cottage industry folks, not really at scale, not using technology, doing that product. And the average pricing, when you annualize those rates, was about 150% APR. So, that was sort of bookending the other side of the market. And we knew we wanted to create the blue chip alternative to a bank loan for small businesses. And so we also knew that the short-term structure was very important to us. So we thought that one of the errors that traditional lenders had made when they looked at small business lending was really making 5-year bets on small businesses. Small businesses are inherently always going to be riskier than consumers because people have multiple jobs during their careers, but they're obviously going to maintain one consumer profile. And so looking at that, we said, let's pick a price point that's about a third the cost of the non-bank alternative that's out there. Let's bring technology to bear on the problem. So we take a sales cycle of 3 or 4 weeks to get a merchant cash advance. We brought that down to minutes and days over the last couple of years. And then as you noted, it's the annualized rate is 54%, but the actual dollar cost on a 6-month loan of a 54% annualized rate is about 15 cents. And so here's how our business owners think about that. Why is this a sound decision for them? What they're looking at is, I'm buying $1 of inventory. Inventory is the most common use of our product. I buy that $1 of inventory. I pay 15 cents in financing cost, and then I sell that inventory through for $1, $2, let's say over 6 months. That's a 200% annualized return. So the key is really just looking at apples to apples. If you want to annualize the rate of the loan, you should annualize the customer's return, or conversely, just look at the dollar cost of the loan and look at the dollar return to customers. And so 80% of our loans are used to grow businesses. And so whether it's buying inventory, buying assets, expanding your workforce, investing in seasonal demand, opening a new location, remodeling, these are all investments that business owners understand well, and they can make over a very short time period and see results. And that's when our financing makes sense. There are definitely times when it doesn't make sense. For example, debt consolidation is not a good use of our product. It's really about incremental growth investments in the business. And I guess as you noted, our Term 24 product, we're not stopping kind of here. So as we build scale now, what's great is that we can operate this business at lower price points to customers. So our Term 24 product comes down to 20% APR. And we've announced a product with BBVA Compass that prices in a similar range, around the range of business credit cards. And actually, if you look at our financials, which are in public, but you would see that our pricing is actually coming down every quarter. So we're confident that as we continue to build scale in the business, we can continue to pass on these savings for customers. But even the products as they are today make a ton of financial sense for folks. We just see business owners optimizing for lowest total dollar cost versus lower APR all the time.
Right, sure. So then you've got, let's just keep, flesh this out a little bit more. You've got, let's just say, you've got a $50,000 loan. There's a restaurant they need to expand their kitchen or whatever it is they need something that's really going to grow their business. So they take a $50,000 loan out, and it's a 6-month loan that's fully amortizing. So it's going to cost them, if it's a 50% APR, which that would be $25,000 annually, but because it's fully amortizing, they're only going to pay 12,000. Hang on, let me think.
Even
about
less
it.
than that,
Yes.
It's you got to divide by 4.
Yeah, got to divide by 4.
So
yeah.
it's it would be about 15 cents on the dollar. So let's just make
Right.
it 15 to keep the math easy.
Sure.
So you're going to borrow $50,000 and you're going to pay back 15 cents in interest and fees. That'd be $7,500 total.
Right.
And what we're asserting, and actually what we see all the time in the choices our customers make, is we will offer that customer. So that's a 50% APR. We will also offer the same customer, let's say a 12-month loan, at a 30% APR, but the dollar cost is going to be higher, right? Because the loan is outstanding longer. We see customers choose the shorter term, higher APR loan all the time. So I think the key is, if the business owner is confident in the investment they're making and they're confident in the time it's going to take to pay back, you really just want to minimize the total cost of the loan, and that's what we see people doing.
Right, and that's okay. And so if this person had good personal credit and could take out, could run that up on their credit card, that would be, would you say that would be a better option for them if they're going to, assuming their credit card rates are 18% and they're going to pay it off over the course of 6 months, the same duration? I mean, what is the reason that they wouldn't do that?
I think that's right. I mean, I think if a credit card was able to give that particular borrower an extra $50,000 at that exact moment, and you had a lower rate, of course you would want to take that.
Right.
The challenge is, I think, a couple things. First of all of our customers have business credit cards, so it's not that they don't.
Right.
The challenge is that business credit cards are underwritten using the FICO score of the business owner.
Yep.
So there's really no emphasis on how well that business is actually performing. And as a result, the average credit card line extension, let's say you want to make this $50,000 investment, you call your credit card company, it's usually $3,000 to $5,000. So it's fine for everyday expenses, but when you have an opportunistic project-based investment in your business, the credit card isn't going to take you all the way to getting that full $50,000 credit assigned to you. And so that's really the gap that we see in the market, frankly, is that because so much of the market is underwritten using FICO, they ignore the strength of the business. And they're essentially underweighting the ability of these businesses to take on debt to grow. And that's what the gap that our product fills. Right.
So then if, now that there's a few more options in the market, I know you really were the pioneers here, but now you've got Lending Club coming on board. You've got Funding Circle making some inroads, who are really, lower APR, longer term loans. I can imagine you're going to see, some of those, some of your clients are going to look there when they're comparing products. What is let's just even take your OnDeck 24. Why should someone take the OnDeck 24 product rather than a 3-year loan with a lower APR at Lending Club or Funding Circle?
Yeah, I think a couple reasons. I mean, first of all, the OnDeck Term 24 product would be a 20% APR. So you're saying, why would you take a 20% APR over 2 years versus, say, a 15% APR over 3 years? Bottom line is you'd still pay lower total interest in that first scenario. So there's a cost reason. If you know your investment's going to pay off in a 2-year time frame, why keep those dollars outstanding longer? Because we've loaned over $1 billion now to small businesses. Lending Club, who's done an amazing job, obviously, in their core market, is just getting into this. Funding Circle, has a nice track record as well in the UK, just getting into it in the US. But we know that having loaned over $1 billion, our OnDeck score allows us to approve a much bigger chunk of the market than those folks will with their approaches. The speed of our process will be much faster. It will be much less documentation intensive for the business owner because we're collecting so much data electronically now. Mm-hmm. And really the benefits of also service as well, we hear from our customers, is that once they work with us, if they want to come back for a second loan or a third loan, it's even easier. So yeah, that's why we created Term 24, though, is that we really believe that we have a chance to follow business owners through their life cycle from sort of startup phase to growth phase to maturity. And products like Term 24 are important because once a business is mature, they are going to want to borrow at longer terms and lower rates, and we now have a product on the shelf that can meet that need. Right, and then maybe obviously you're going to see some of your clients graduating to an SBA loan that is, single-digit APRs that over a longer term as well. I mean, I imagine you've seen some of that in your customer base as well. You bet. And we're happy when that happens. I would say one of the core benefits of our product, unlike the merchant cash advance space that was sort of predominant when we entered, is that we actually report our loans back to the business credit bureaus. So I think what's cool about what OnDeck is doing is, we're interested in lending to a business almost before any other traditional lender will be. They can be at an earlier stage of their business. We
Right.
have the technology and the data to analyze their credit worthiness before the traditional market catches on. But as they grow with us, as we understand that business better, we can offer, better rates and longer terms. And we're always reporting back to the business credit bureaus. So what we found is that not only can businesses maybe one day get an SBA loan where they couldn't before, but even something more mundane like trade credit. Because we build that business credit track record with them, we report it back to the bureaus. Then one of their suppliers might say, hey, instead of asking for cash on receipt, I might give you 30-day terms or 60-day
Right.
terms for your business where I didn't before.
Sure. So let's switch gears to talk about underwriting. I know at Lender you said that around 70% of the loans that you do today are completely automated. No human being actually looks at the loan before you send the money out. So can you talk a little bit about how you've been able to do that and how just your underwriting process and the building of this OnDeck score and just talk about the kinds of data and stuff that you're using to make that, to be able to do that?
Absolutely. And to be clear, the 70% I was talking about was more on the actual underwriting and loan decision itself. There are people who look at the loans as a final check before funding and what have you, although there's
Okay.
a substantial fraction of the loans that don't touch anyone. But I just want to be double clear on that.
Okay.
But more importantly, what we've really built with the OnDeck score is essentially a different way of analyzing the credit worthiness of a Main Street business. We use both traditional and non-traditional data, but the key is no matter what data we use, it has to be real-time and third-party verified. So today, across dozens of data sources, we collect about 2,000 different data points in every business loan application that we process. And I think what we've gotten, frankly, reasonably good at over the years is when the diversity of the businesses, takes hold, when you have businesses that are stronger in their data in one aspect of the sources we look at or stronger in another, we know what to weight and what to not weight to come up with a good credit decision. Mm-hmm. And so I think that's really a lot of the secret sauce that's gone into the OnDeck score over the years. It's not just getting better at decisioning the loans themselves and identifying important credit features and patterns in this data, but also handling diversity and recognizing that a $2 million revenue business is very different than a $200,000 revenue business and should be treated differently from an underwriting point of view.
Right. And so then you're also, obviously, you said 700 different industries or something. I mean, you're benchmarking them, I imagine, against all the other people in your own database.
Right? That's right. And it's, tens of thousands of loans, hundreds of thousands of applications. And so it's a very rich data set at this point. It's improving all the time. And there's benchmarking that goes on from an industry perspective, from a geography perspective, and from a size of business perspective.
Right. Okay. And then, so there's been a lot of talk about alternative data. We had a whole session on it at Lender. That you were on that panel, and you talked about the noise. There's a lot of noise in sort of some of the social data and the alternative data that's out there on businesses. Like a bad Yelp rating might just you don't want to make a credit decision on someone who's had a bad experience with the food at your restaurant. But what can you tell us about some of the things that are useful in making a credit decision with non-traditional data sources?
Yeah, no, happy to. I think you picked up on it. You have to be careful about what is noise and what is signal. But we look at things like frequency and timing of online reviews, for example. So we also look at things like presence or absence. So it's a very simple kind of binary indicator. But if you're a restaurant and you're applying for a loan with OnDeck and you don't show up in a Foursquare or a Yelp or an OpenTable or a Google Places, are you really out there, or is something else going on? And really today, any restaurant worth their salt is going to be present in some of those data sources. So what we try and do is extract much more kind of quantitative and numerical signals from these data sources. Like another example would be if someone tells us online that they're doing $2 million in annual revenue, but they only have one online review in the last 3 years. Mm-hmm. That's probably a red flag.
Right.
And so that's been where it's been particularly helpful. I mean, I would emphasize that what OnDeck's really trying to do is look at business fundamentals. We're looking at cash flow. We're looking at business credit. We're looking at debt service and ability to repay. And it's kind of all the classic things you might look at in a human underwriting process, but we're just doing it at warp speed using technology as opposed to people doing the heavy lifting.
Right. That makes sense. So let's switch gears to talk about that survey you recently did.
Sure.
That said, you've analyzed the economic impact of the $1 billion plus in loans that you've issued. And, you come up with 22,000 new jobs, $3.5 billion of economic impact. Can you just break down how those numbers were worked out and flesh out a little bit more about that survey?
Yeah, no, happy to. It was obviously very interesting data and results. We didn't frankly know what it would say in advance. We had a third-party firm do the survey called the Analysis Group. They're an economic consulting firm with a great track record working for a lot of major corporations in the U.S. And we received survey responses from nearly 1,000 of our customers that were very, very detailed. And so that enabled us to get a real window into how our product was operating. Mm-hmm. So why were we able to create such an economic impact? The key finding here, Peter, is that this lending is incremental. These loans were not getting made before. And so when you look at an application like debt consolidation, for example, essentially what you're doing is you're moving a balance from, say, one credit card company to another. And that's not creating necessarily incremental debt capital available in the economy. It's sort of just a balance transfer, if you will, from one institution to another.
Right.
What we found is that over half of our customers never even applied anywhere else. They were sitting on the sideline, and they were essentially convinced that either one of two things was going to happen. Either it was going to take too long and be too much hassle for them to apply for a bank loan, or that they thought they weren't going to be approved because they were in an industry that the banks didn't like, they were too young of a business, or their personal credit wasn't pristine, let's say. And so those two reasons really discourage a lot of business owners from applying at all. When they saw the OnDeck value proposition, that's what sort of got them off the couch, so to speak, and onto the computer and applying. And that makes these loans very incremental. So when you look at that and when we broke it down, the vast majority of these loans were not getting made before by other folks. And then when you sort of run the math, there was a sort of standard econometric model that the consulting firm used called Implan that says if you inject $1 billion of capital in, they looked at every use case for the loan. The most common use case is buying inventory, for example. So when you buy inventory for your business, you are not only growing your business, but you're buying from someone in your supply chain. You're growing their business as well. And so you have effects that are direct, kind of the money spent within a business. You have effects that are indirect in the upstream supply chain. And then, there's another effect called induced effects, where simply having more employment creates more consumer spending, and there's a ripple effect from that. So long story short, when you ran the models, when you looked at all the different use cases of the loans, when you surveyed the business owners, the numbers cranked out about $3.4 in impact for every dollar that we lend. Right.
And then the jobs, so how many loans did you make that created those 22,000 jobs? How many is it?
It's roughly in the same order of magnitude, a low tens of thousands of loans to create the job. So yeah, and it's not dissimilar. I've seen other kind of nonprofit groups who have done these kinds of studies, and the ratio I had seen prior to our study was something like, for every $30,000 loan, you create one job net. And so these numbers weren't too far off from that.
Right. Yeah, it makes sense because if the business owner is either going to get an OnDeck loan or not get a loan at all, then you can obviously it's incremental and there's more, you can see how it would create the impact that it does. So that's
exactly. No, which is exciting. And I think, getting back to some of your early questionings, that's why our business is growing so quickly. The market is speaking. There's definitely a demand for these shorter term investments in businesses and the shorter term capital to match up with those investments.
Right. Sure. So I want to let you go, but before you go, I've got two more questions. And one about your recent securitization. I think you said it was the first securitization of non-SBA business loans. Can you just share with listeners a little bit about how you put that together and why you put that together?
Sure. Happy to. So, we are always looking to continue to diversify our funding sources because we don't use retail investors. We wanted to open up our funding to more institutions. We felt that the OnDeck score was at a sufficient degree of maturity that we could pass a institutional kind of rating process, which we did with an investment grade rating. And so it was just the next logical step in evolving our capital structure. So, we worked with the rating agency over a period of many months. I think it was about 6 months of work, kind of end to end. And what's cool about the securitization is if you look under the hood, it's based on the OnDeck score. So it's not based on FICO. Most of the securitizations in consumer loans are sort of FICO driven or annual income of the borrower driven. This is really based inherently on the OnDeck score. And it's a little bit of a, not only is there a reason to do it, we think from a cost to capital point of view, but it's also a little bit of a good housekeeping seal of approval on how we underwrite our loans. And that's been important as we start to go out now and forge bigger partnerships with banks and large non-banks who serve small business. They're looking for proof points around OnDeck, and we felt that this was a very public way to say OnDeck knows what they're doing.
Okay, sure. So then last question then, where is OnDeck going from here? I mean, are you sticking with your core business here? I know you just released OnDeck 24. Is there going to be an OnDeck 36? I mean, where are you going? Where are you taking the business from here?
I think a couple things. One is, we recently, kind of had a strategy offsite where we focused a lot on where do we want to be in 5 years. And I think one of the key takeaways from it is we're 100% focused on small business. So one thing you're probably not going to see from OnDeck is we're not going into the student loan space. We're not going into consumer lending or so forth. I mean, we think our core competency is underwriting these small businesses at the smaller end of the small biz scale. So that's a big focus for us. And then what I alluded to earlier, this idea of following small business owners and creating products for them throughout their life. So if you look at a small business in the startup phase, in the growth phase, and in the maturity phase, how can OnDeck have a compelling credit offering for them, supplying credit in different form factors to the business over different rates and terms, but also, different product structures as well. And so we think that there's a lot of opportunity to grow and expand with new products sold to the same customer set and with sort of products targeted at different phases of the small business life cycle. So, so we're very, very bullish. I think the final thing I'd add is just this idea of partnerships. We announced a very successful partnership with BBVA Compass. We have a successful partnership with Intuit. These are all some of the blue chip companies that now, having seen us lend $1 billion, are comfortable working with us to power small business lending programs for their customers. And we think we're unique in having that kind of track record, but also the innovation and the nimbleness to get these programs up quickly and scalably. So that's it. We just want to be the best small business lender in America, and we're really focused on that for the time being.
Okay, well, great. This has been great, Noah. I really appreciate your thoughts here. It's been fascinating to hear more about OnDeck and the small business space. So thanks a lot for coming on.
No, thanks for having us, Peter. We really appreciate it.
Okay, great. See ya.
Take care. Bye.
Bye. Okay, there you have it. There's no question that OnDeck are fulfilling a need in the small business lending space. They've been very successful. They obviously have a lot of satisfied customers. Now, some businesses would never consider applying for an OnDeck loan. Some people have the luxury of being able to have the time and energy to apply for an SBA-backed loan. For others, they have the capability, but they choose not to. And others simply don't have that option. And I think going the OnDeck route is going to be a sensible choice for a lot of those kinds of businesses. And even I appreciated Noah saying like the total cost of the loan is what a lot of companies look at. Because if you take out a 7-year SBA loan, you're going to have a pretty large interest total payment over the life of that loan. You take out a 6-month loan or even shorter, you're going to have a much lower total cost of interest, where the APR, obviously, really, you're comparing apples with oranges when it comes to APR. But, the total cost of the loan is one of the many factors that small business owners should consider. Anyway, on that note, I'm going to sign off, and I will catch you next time. Thanks for listening. Bye.